All right, so let's dive into something I'm sure is on a lot of minds out there lately, interest rate cuts and what they could mean for, your investments. We're going to be dissecting a recent Motley Fool article from January 21st of this year, 2025, that really got me thinking. It breaks down where interest rates might be headed this year and how all of that could shake things up in the stock market.
Yeah, it's a real puzzle, isn't it? Especially with the Fed, trying to keep inflation in check and also at the same time keep the economy, moving smoothly.
Exactly. So this article starts by reminding us that the Federal Reserve, the Fed, has that dual mandate, keeping inflation around that 2% target and aiming for full employment. Sounds pretty straightforward, when you just say it like that, but in reality...
The reality is a lot more complex.
It's so complex.
For sure. And this article highlights just how challenging that balancing act can be. Remember back in 2022, when inflation hit that 40-year high of 8%. The Fed had to slam on the brakes, raising interest rates really aggressively. Between March of 2022 and August of 2023,
yeah, it did seem to work, though, right? Inflation did come down. It came down to 4.1% in 2023, and then even lower in 2024. So that gave the Fed, a little bit of breathing room to start cutting rates again towards the end of last year. But here's where things get really interesting. This article mentions that inflation unexpectedly ticked back up in late 2024, hitting 2.9% in December. So just that little uptick, that stickiness in the consumer price index, it's making the Fed a bit cautious.
Right. It's like, imagine you're trying to gently lower a heavy object, but it keeps getting stuck.
Yeah.
That's kind of what the Fed is dealing with here. They're trying to ease those interest rates down, but this, stubborn inflation is giving them pause.
Yeah, that makes me wonder, is there a risk that they could overcorrect? If they cut rates too quickly. While inflation is still, kind of lurking out there, wouldn't that just make inflation worse, later down the line?
It's a valid concern. And it's likely why we're seeing this difference of opinion between the Fed and Wall Street. So the Fed's projections, which are laid out in their Summary of Economic Projections, or the SEP, point to 2 more interest rate cuts in 2025. But get this, Wall Street traders are betting on only 1 cut, probably in June.
Hold on, back up a sec. What exactly is this SCP? Then it sounds kind of like a secret code the Fed uses.
Yeah. Think of it as a peek behind the curtain of the Fed's thinking. It's their way of sharing their outlook on the economy. So in this case, the key changes between the September and December 2024 SEPs show that they've actually revised their GDP growth and inflation projections upwards. So they're basically saying they're expecting the economy to be a bit stronger, maybe even a bit more inflation in 2025, which might explain why they're considering those 2 cuts.
Okay, interesting. So the Fed is leaning towards more cuts. Wall Street seems less convinced. This difference of opinion is really intriguing, and I imagine it has some, direct implications for the stock market, right?
Absolutely, and that's what we'll delve into next.
Okay, so we've got this interest rate puzzle, these differing opinions on what the Fed might do next. But let's get down to, the real nitty-gritty here. What does all this mean for, our investments? Most of us aren't economists. We just want to know how these big decisions could impact, our portfolios.
Yeah, that's the million-dollar question, right?
Yeah.
And then this article, dives right into that. So generally speaking, lower interest rates tend to be good news for the stock market. It's like giving the economy a little bit of a caffeine boost.
Okay, I like that analogy. Tell me more about this caffeine boost.
Well, for one thing, lower interest rates make it cheaper for companies to borrow money. Think of it like, a business getting a really good loan deal, and suddenly they have more financial fuel to invest in expansion research and development, all those things that can drive growth and potentially lead to higher earnings. And when companies are earning more, their stock prices often follow suit.
Yeah, that makes sense. Investors love to see, companies with healthy growth potential. But it's not just about, companies having easier access to money, is it?
Right. Lower interest rates also have this ripple effect on other types of investments. Think about those kind of safe investments, like bonds. When interest rates go down, the yields on those bonds also go down. So that makes them less attractive to investors who are seeking a steady return.
So it's like the seesaw effect. As interest rates go down, the appeal of bonds goes down, and then suddenly stocks look a lot more exciting by comparison.
Exactly. And that increased demand for stocks can push prices higher, but hold on, because there's a catch. The article points out that every rate-cutting cycle since 2000 has been followed by a temporary dip in the S&P 500.
Wait a minute. I thought we just established that lower rates are good for stocks. Now you're telling me that the market takes a dip? That seems kind of counterintuitive.
It is. It's one of those market quirks that can really trip up even seasoned investors. So this dip it isn't necessarily because of the rate cuts themselves. It often has more to do with the underlying economic conditions. That prompted the Fed to cut rates in the first place.
Oh, I see. So if the economy is already showing signs of weakness, the Fed might cut rates to try and stimulate growth, but that underlying weakness can still kind of weigh on company profits, and stock prices are ultimately tied to how well those companies are doing.
Exactly. Investors need to look beyond just the rate cuts themselves and consider the broader economic context.
Okay, that's a good point. It's not just about cheering for rate cuts. We need to understand why those cuts are happening and what they might signal about the health of the economy overall. Speaking of economic health, I'm curious about something the article mentioned. It said the unemployment rate ticked up in 2024. Should we be reading into that? Could that be a sign of trouble brewing?
Yeah, it's definitely something to watch. Remember, one of the Fed's mandates is full employment to a rising unemployment rate. It could be an early warning sign that the economy is slowing down,
Right.
like a canary in a coal mine, a subtle indicator that things might be shifting.
This is getting complex.
Yeah.
But it's also really fascinating to see how all these pieces fit together. Interest rates, inflation, employment, and then ultimately, the stock market. It's like we're trying to solve this giant economic puzzle. Now, I want to circle back to the Motley Fool article for a minute because they had some interesting thoughts about the Fed's actions and some advice for investors like us.
Right, and their perspective might surprise you. They actually seem to be in Powell's corner on this one. They praised his proactive approach to cutting rates.
Yeah.
Even though inflation hasn't, completely vanished.
Okay, that's interesting. So they're saying he's learning from the Fed's past mistakes of keeping rates high for too long, which often contributed to those economic downturns.
Exactly. The article points out, those historical missteps, and it suggests that Powell is trying to avoid repeating them. So he's walking this tightrope, trying to find that sweet spot between supporting growth and keeping inflation in check. It's a delicate dance. And the Motley Fool seems to think he's doing a decent job so far.
Okay, so they give Powell like a thumbs up. But what about their advice for long-term investors? What are they telling people like us to do in this environment of rate cuts and potential market volatility?
Their advice basically boils down to this: don't panic if the market takes a dip. In fact, they actually suggest seeing any market correction. That's triggered by a weakening economy.
That's a buying opportunity.
Okay, so rather than running for the hills when the market gets bumpy,
Yeah.
they're saying we should see it as a chance to buy stocks at a discount.
Yeah, that's the gist of it. They tie this back to the historical trend of the S&P 500, always reaching new highs eventually. So they're saying trust in the long-term upward trajectory of the market, ride out the waves. And in the long run, you'll come out ahead. That's a reassuring perspective. But this whole conversation has really highlighted how much we need to consider, the bigger picture, not just what's happening with interest rates in isolation.
Absolutely. It's all interconnected. And speaking of interconnectedness, the article focused mainly on the U.S. economy, but it didn't really touch on that global landscape. Don't you think that's a crucial piece of the puzzle as well? What's happening in other major economies? I mean, it could definitely influence the Fed's decisions and the direction of the stock market.
You're so right. It's like we've zoomed in on one section of this giant tapestry, but we need to pull back and see how it all fits together.
Exactly, and that's something we'll explore next.
We've been dissecting this Motley Fool article, all about interest rates and the stock market, but we've been mostly focused on the U.S. side of things. What I'm really curious about is how global economic conditions could throw a wrench in the works. Like, what if other central banks around the world start making moves that contradict what the Fed is doing here?
Yeah, it's like a giant game of tug of war, right, with everyone pulling in different directions. The reality is the U.S. doesn't exist in a bubble. The Fed has to consider what's happening globally because those actions can create a ripple effect right back to our shores.
Okay, so paint me a picture. Let's say Europe is teetering on the edge of a recession, and the European Central Bank decides to slash interest rates to try and jumpstart their economy. How would that impact what the Fed does here in the U.S.?
Well, it could put the Fed in a really tricky spot. I mean, imagine the U.S. is trying to gently tap the brakes on inflation, while Europe is slamming on the gas. That difference in interest rates could cause the U.S. dollar to surge in value compared to the euro.
And a strong dollar isn't necessarily a good thing, is it?
Right. While a strong dollar sounds good on the surface, it can actually hurt U.S. companies that are trying to sell their products overseas because suddenly their goods become more expensive for European buyers, which could impact exports and ultimately U.S. economic growth.
So even if the Fed wants to stay the course with its current plan, they might be forced to react. to what's happening globally. It's like they're playing chess while everyone else is playing checkers.
Exactly. It's this constant game of strategy and adaptation. And it works both ways. Let's flip a scenario. Imagine China and Japan are grappling with high inflation, so they decide to raise their interest rates to cool things down. Well, that could actually give the Fed more leeway to keep rates higher here, even if it causes a little, short-term turbulence in the stock market.
Wow, my head is spinning a bit. Trying to predict the stock market based solely on U.S. interest rate decisions seems almost impossible without considering this whole global context.
Yeah, you're hitting the nail on the head. The U.S. stock market. It doesn't operate in a vacuum. You've got global capital flows. Those dollars zipping around the world, currency fluctuations, the economic health of other nations. All of that plays a role in how our investments perform.
So what's the key takeaway for our listeners then? I'm guessing it's not as simple as just watching the Fed.
Right. Staying informed about global economic developments is crucial. Keep an eye on headlines about interest rate decisions by other central banks. Pay attention to the, economic growth trends in major economies around the world. It'll give you a much more comprehensive perspective.
It's like we need to become global economic detectives.
Exactly. The more informed you are, the better equipped you'll be to make smart decisions for your investments.
Well, that wraps up our deep dive into interest rate cuts, inflation, and the stock market. We covered a lot of ground today. From the Fed's balancing act to the Motley Fool's perspective, we even ventured into the complex world of global economic interconnectedness. Hopefully you're walking away with a deeper understanding of how all these pieces fit together and how they can impact your portfolio.
Remember, knowledge is power. Stay curious, keep learning, and never stop exploring.
Until next time, happy investing.